Stagflation is characterized by the concurrent occurrence of stagnant economic growth, high unemployment, and rising inflation. This phenomenon is particularly challenging because it defies traditional economic theories, which often suggest that inflation and unemployment are inversely related. The term stagflation is a combination of the words stagnation and inflation. Stagflation poses significant challenges for policymakers because the tools used to address one aspect of the problem often exacerbate the others. For instance, measures to combat inflation, such as raising interest rates, can further slow economic growth and increase unemployment. Conversely, policies aimed at stimulating growth, like lowering interest rates or increasing government spending, can worsen inflation. The effects of stagflation are far-reaching and detrimental. For consumers, rising prices erode purchasing power, making it harder to afford goods and services. High unemployment adds to the economic strain, as more people struggle to find work. Businesses also suffer, as reduced consumer spending and higher production costs squeeze profit margins. Investors face challenges as well, as traditional investment strategies may not perform well in such an environment. The stagflation of the 1970s and the current economic conditions of 2025 share some notable similarities, though the contexts differ. In the 1970s, stagflation arose from a combination of supply shocks, such as the Organization of the Petroleum Exporting Countries, OPEC, oil embargo, and policy missteps that led to high inflation, stagnant growth, and rising unemployment. Similarly, in 2025, concerns about stagflation have been fueled by supply chain disruptions, trade tensions, and inflationary pressures. For instance, recent tariff policies have increased costs for businesses and consumers, echoing the supply shocks of the 1970s. These tariffs have raised prices on imported goods while disrupting global trade, leading to slower economic growth and higher inflation. Another parallel is the increased rate of unemployment seen within the first 4 months of 2025. This is causing consumers, both employed and unemployed, to be very cautious about spending, which is slowing down the economy. We see policymakers in both periods are finding it challenging to use traditional economic tools to solve the problem. Efforts to curb inflation, such as raising interest rates, risk further slowing economic growth, while measures to stimulate growth could exacerbate inflation. This delicate balancing act complicates the response to stagflationary pressures. However, there are also key differences. The 1970s stagflation was heavily influenced by energy crises, whereas the current concerns are more tied to trade policies, geopolitical tensions, and mass firing of government workers. Additionally, advancements in technology and globalization have changed the economic landscape, potentially altering the dynamics of inflation and growth. While the U.S. economy in 2025 has not fully entered a stagflationary period, the warning signs are evident. Rising inflation, slowing growth, and declining consumer confidence mirror some aspects of the 1970s. These parallels highlight the importance of learning from past experiences to navigate the current challenges effectively. By addressing structural issues and fostering international cooperation, policymakers can work to mitigate the risks of stagflation and promote economic stability. The question is posed, what should an investor do to save and grow their money during these times? Since stagflation, characterized by high inflation, stagnant economic growth, one of the key strategies during stagflation is to focus on assets that tend to perform well in inflationary environments. Commodities, such as gold, silver, and oil, are often considered safe havens because their value typically rises with inflation. Gold, in particular, has historically been a reliable store of value during economic uncertainty. During periods of stagflation, when inflation is high and economic growth is stagnant, traditional investments like stocks and bonds may underperform. In contrast, gold and silver tend to retain or even increase their value, making them attractive options for preserving wealth. Gold and silver are often considered reliable investments during stagflation due to their unique characteristics as tangible assets and stores of value. Gold, in particular, has a long history of being a safe haven asset. Its value is not directly tied to the performance of any single economy or currency, which makes it fend against inflation and economic uncertainty. During stagflation, when the buying power of their national currencies declines, investors often turn to gold as a way to protect their wealth. Historical data shows that gold prices have risen significantly during past periods of stagflation, such as in the 1970s, when inflation surged and economic growth faltered. Silver, while often overshadowed by gold, also performs well during stagflation. It shares many of the same properties as gold, such as being a tangible asset and a store of value. Additionally, silver has industrial applications, which can drive demand even during economic downturns. This dual role as both a precious metal and an industrial commodity can make silver a versatile investment during stagflationary periods. Real estate is another avenue that can offer protection against inflation. Rising property values and cash flow from rental income often increase with inflation, making real estate a potential hedge. Real estate investment trusts, or REITs, allow investors to gain exposure to the real estate market without directly owning property. However, it is essential to focus on sectors of real estate that are less sensitive to economic downturns, such as residential or healthcare properties. Dividend-paying stocks, particularly those of companies with strong balance sheets and pricing power, can also be a valuable addition to an investment portfolio during stagflation. These companies can pass on higher costs to consumers, maintaining profitability even in challenging economic conditions. Sectors like utilities, consumer staples, and healthcare often exhibit resilience during stagflation, as they provide essential goods and services that remain in demand. Inflation-protected securities, such as Treasury inflation-protected securities, TIPS, are another tool for preserving wealth. These bonds are designed to adjust their initial investment to match with inflation, ensuring that the investor's purchasing power is maintained. Additionally, short-duration bonds may be preferable to long-duration bonds during stagflation, as rising interest rates can erode the value of long-term fixed-income investments. Diversification is crucial during stagflation. By spreading investments across various asset classes, sectors, and geographic regions, investors can reduce risk and increase the likelihood of achieving positive returns. International investments, particularly in countries with stronger economic growth or lower inflation, can provide additional opportunities for diversification. Maintaining liquidity is also essential during stagflation. Economic uncertainty can lead to unexpected expenses or investment opportunities, and having access to cash or cash-equivalent assets ensures flexibility. High-yield savings accounts or money market funds can provide a safe place to park cash while earning some return. Investors should also consider alternative investments, such as private equity, hedge funds, or infrastructure projects. These investments often have low correlation with traditional asset classes and can provide unique opportunities for growth. However, they typically require a higher level of expertise and may involve greater risk, so they should be approached with caution. Risk management is a critical component of any investment strategy during stagflation. Investors should regularly review and adjust their portfolios to ensure alignment with their financial goals and risk tolerance. This may involve rebalancing asset allocations, reducing exposure to underperforming investments, or increasing holdings in inflation-resistant assets. Finally, staying informed and seeking professional advice can make a significant difference. Economic conditions during stagflation are complex and can change rapidly. Keeping up with market trends, economic indicators, and policy developments can help investors make informed decisions. Consulting with a financial advisor or investment professional can provide valuable insights and tailored strategies to navigate stagflation effectively. Check out our other videos to learn more about how to become financially free.